Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, GREENBERG TRAURIG, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Stephen Napolitano, First American Title Insurance Company, Friedman, LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Giantomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Sterling & Sterling, Urban American, The Wickoff Group.
The accountants, some people look at them as the advisor, the auditor, the tax planner, the consigliere, the person who provides insight to their clients on what they should do. So today I've assembled 4 prominent accountants to provide their insight on what they see real estate in the state of the market. My guests today include Ronnie Conigliaro, who is the managing partner of the real estate practice at Markham LLP, Seth Millard, who's a partner at Burden LLP, David McKelvey, who's a partner at Friedman LLP, and last but not least, my good friend, Ronnie is also, but my good friend, the partner, Jeffrey Levine from Margolin, Weiner, and Evans. You've been through a couple of cycles, consigliere. So how do we look at this cycle? As you know, I remember you saying to me in the 90s, you know, it was like people went to college and they said, you look at the person on your left, and you look at the person on the right, one of them is not going to be around. That was what happened in 1990s in the real estate business. In 2011, how do you see the market? Improvement? Is it great? What's happening?
Well, as long as we restrict it to Manhattan for this part of the conversation.
Wait a second. What about Brooklyn, New Jersey?
We'll get there. We'll get there. We have to start somewhere. But in Manhattan, things are encouraging. We see a lot of leasing going on at reduced prices. And these are either buildings that are old and cold debt, which hasn't been overly refinanced. I pity the poor people that purchased properties in 06, 07. They're going to have a tough time. And the lenders are going to have a tough time. And maybe your 401k will have a tough time because you might be holding that debt. But there's activity going on the commercial side. The residential side, prices have certainly come down. We represent a number of builders selling condominiums. Is it slow? Yeah. Is it picking up? I think we've hit bottom. That's encouraging. We go to the outer boroughs with multifamily. It's tough. You have lots on Long Island where houses are deep underwater. So they could stay there and live there for nothing until the banks get around, because who knows when they're going to foreclose. Is the population going up? No. Is employment going up? No.
So we're really talking about a tale of two cities.
Absolutely.
You know, it's really that centric. You know, you have an office, and you have both offices. You're in Manhattan and in Long Island.
Correct,
right?
in Uniondale, as well as 3 in New Jersey.
No, but I know I think your office is specifically in Uniondale also?
Right, I go back and forth.
So what are you seeing happening in Long Island with regard to the real estate market in general?
It's a little flat. There's a lot of vacancy. There's some new construction that's going on. But Long Island usually follows Manhattan. After Manhattan amps up and rents increase, people start to look to the outer boroughs. So Long Island's a little soft at this point.
Now the big problem, Long Island is also a two-city situation. Nassau and Suffolk, the real estate taxes are so great in Nassau as compared to Suffolk. I mean, you used to live in Garden City.
Yes, and real estate taxes are substantial. And I do agree with Dave as far as Nassau County, and also see in Suffolk County, I see there's negative. I would say not much growth at all, and the employment situation is not improving, and rents are declining. So and the vacancy rates is also is not declining. So I think there's the issue in Nassau or Suffolk County. It's not the issue that Manhattan has.
You know, real estate in general in New York and around the country is broken down. You have different type of ownerships. Manhattan and New York City has one major type of ownership called the families. We won't call it the Don Corleone 5 families, but there are the families who are established, who are really, their relatives came over in 1900 and they started with one building or something like that. They own a variety of offices. And I know many of you represent those families. Then you have the REITs, and then you have the guys who have the private equity. Who do you see? Who's the most active today? What are you seeing happening with your firm and your clients?
We see the REITs being very active. The families are, you know, a little bit less aggressive on buying because they're generally more conservative. They're not jumping at, you know, anything that's on the market. The REITs are definitely more willing to, you know, buy at, more aggressive pricing. But the families we see are doing a lot of recapitalizations. You know, they're looking at their own structures, they're buying back some of their debt, some of their properties that are on the fence, they're refinancing, maybe going back and renegotiating with the banks, maybe putting a little bit more equity into it and basically setting it up for the next cycle.
But you know, that's a really good point of view, perhaps, and I know Jeff has represented families over the years. Money is still inexpensive for real estate debt. You know, we have LIBOR. I mean, T-bills have spiked up because of what's happened in China, in Japan, and in the Middle East. But if I was a family, I'd probably like to refinance now for 5 or 10 years, lock it up, and be protected, as opposed to being risky. What are you seeing?
Rates would indicate that. However, the loan-to-value issue becomes the major part. If you lock it up for 10 years, if you want to pull out cheap capital, you're not financing, as in the old days, of 75% of a value. Maybe it's 60%, maybe it's 50%. Do you really want to lock that up for 10 years? It depends upon the wealth of the family and what their expectations are with that capital.
Right?
Yeah, and also depends on the maturity of the existing debt. So we've been looking at our clients' our debt maturity schedule, and anything that's 2 to 3 years down the road, we've been looking to refinance today and get the better rates. And
you know, here's an interesting thing with regard to the families. You know, it may be the 3rd or 4th generation today of the family, and some of the families, they have the younger son or the younger daughter who may be in their 30s or in their 40s, who wants to show that they want to show, hey, I'm not living on my family income. Even though they are living on it, they want to do something. I mean, you know, there are many people, including your client, who didn't live on the merits of his family and really grew, you know, like a Scott Reckler, who's been a good friend and on the show. How do you see some of these younger family members saying, hey, dad or mom or everything else, I really want to invest. It's a time we should, even though the father or the family, the patriarch may say, hey, you know, let's stay back. You know, I like keeping safety. What are you seeing, David?
I actually see it both ways. I see some younger family members that want to deleverage. They don't like the stress of what they've gone through in the last few years, and so they're really encouraging to deleverage. And then you do have the young ones that want to prove themselves, that want to feel that money's cheap. You got QE2, and everything is working out pretty well for them, and they can feel they can redeploy it and buy some distressed buildings and get in the right position.
Seth?
I agree that the younger generation's probably a little bit more aggressive, and what I've seen is if the patriarch is still around, they're gonna put the brakes on a little bit. But you know, those patriarchs didn't get there by being super conservative either. So they're all
point,
shrewd
very good point.
investors. They've taken many risks in their careers at different times. So, you know, I definitely see a little bit more aggressive nature from the second generation, but it's, you know, the patriarch, you know, unless they're gone completely out of the picture, we've seen that it's very hard for them to release the control and just let the younger generation go. We do see, you know, that tension there, and that's part of our jobs, is to sometimes be that intermediary between those generations.
I brought this up prior to the show that there was an interesting fact. You know, REITs have been active players in New York City. You know, you have the major office REITs, the Vornado, the SL Greens, the Boston Properties. There have only been, there used to be 4, but Archstone is no longer a REIT, an operating REIT. There were 4 residential REITs who've been active in the city. There's been Avalon Bay, Equity Residential, you know. Recently, UDR, Denver-based UDR, the other REIT who is also here is AMCO, which was based out of Denver. UDR recently entered a contract and purchased 10 Hanover Square from Steve Witkoff. And as opposed to taking cash, Steve took REIT shares. Do you see more people taking REIT shares because of the tax benefits, the postponement? What do you see? Do you see that?
Well, typically, we saw that in the early 90s, using the UPREIT and taking OP units, and it was a deferral concept. You're riding with that REIT, that's your bet. You can get out in theory whenever you want, if they'll allow you. And if you believe in deferral, then it's fine. One could argue, how long is this game going to last? There's a lock on their mortgages, when they can refinance, when they can't refinance. And our tax rate's going to stay low.
So wait, you're sounding a little pessimistic. It sounds like if somebody came to you and your client, you wouldn't have told them to stay with a company like a UDR or an Equity Residential. You'd say, take the money and run.
Yeah. I look at a 15% cap gain rates and I say, you know, it's not going to go any lower. It's not going to go, and there's nothing the matter with having a bucket full of cash.
Also, you know, I think a lot of the people that we're talking about that are selling would rather control their own destiny, so they'd rather roll it into a like-kind exchange into another property and defer it that way, as opposed to letting a REIT essentially run their money. So they'll take a, you know, they'll find a replacement property, which is not so easy to do these days, but they'd rather, you know, defer that way than, you know, through a REIT structure.
Ronnie?
Yeah, we've seen both. We've seen the UPREIT. We're asked typically to analyze the situation, figure out the effective tax rate, which if the property is in New York City and the resident of New York City, you could be looking at, you know, a 35% rate when you combine New York City, New York State, and the federal tax. So we do the analysis and offer the alternative of a tax-free exchange, which if a client, like you said, is a very controlling person, that may be an opportunity if they can acquire controlling interest. But it is difficult to, during a 6-month period, to go find a replacement property and deal with the IRS regulations. The UPREIT status, we've looked at that many times, and if you have a client that is not as controlling and is okay with losing control with the UPREIT is a great opportunity for a tax deferral. And the REIT stocks have performed over the last 2 years exceptionally well.
REIT stocks have been exceptionally well.
Right.
You know, Jeff was talking before about, you know, there's been a lot of money coming into America that they always come to their consigliere, their accountant advisors, to ask the opinion. There's been a lot of money coming from the Middle East. Sovereign wealth funds have been major investors in New York City, around the world, but they like 5 major cities. You know, they're like New York, Washington, Chicago, maybe Boston, Los Angeles. Those were the situations. Today, with what happened in Egypt, what's happening, you know, with Gaddafi and Tripoli and unrest in Saudi Arabia, slight Saudi Arabia, how do you see sovereign wealth funds who have really helped increase the prices of properties in New York affect in 2011?
It'll prove interesting. I mean, what happens in those countries? Who takes them over? We saw them run out of money because they had major financial commitments in Eastern Europe, in Russia, in the United States, in South America, in Central America, and then oil came crashing down on them. They ran out of money, their commitments. We were involved in discussions with a Mideast organization, and they chose to go further with the New York operation and drop off the Poland ones, the Lithuanian ones. They ran out of money effectively. And they had all these strong financial commitments they couldn't honor. And you wonder, can it happen again now?
Yeah, but now, you know, oil has gone up from 35 to 97 to 104, so these people have been putting away a little more shekels in their pocket, right?
Are they our friends, whoever takes over these countries, is the question.
They clearly have a lot of issues to deal with, and you might see some reduced investment there. But then you have, to offset that, you have China. You know, the Chinese are starting to really more heavily invest in the U.S., and you see more of those dollars coming in. So, you know, the dollars seem to come here, whether it's from the Mideast or Europe or, you know, especially with the weak dollar. The dollars do seem to come here, and people do like to invest here. So,
You know, the stable market here, the U.S. market is known to be a very stable market over the long term. And, you know, we've seen a lot of investments recently from Canada into U.S. real estate.
Oh, the Canadian, I mean, I think, Ronnie, that's a great comment. The Canadians have been very strong, and if the money behind the Hudson Yards is the Oxford company, who've committed to put more than 50% of the money in for the development of the Hudson Yards. Then you have Onyx, who took Flushing, you know, with Josh Muss. So, you know, and then PSP, you know, the Canadians have been exceptionally strong investors. What about the subject with regard to companies? At one time in the 90s, 80s, a lot of companies liked to own their own property. Then there was the selling of their properties. And then last year was the biggest sale of all time, you know, of a single asset, Google's purchase of 111 8th Avenue. Do you see companies going back? Because there was a question on the accounting, and I believe you said to me that legislation is off the books. Right?
yeah, the lease accounting.
Yeah, lease
Yeah,
accounting.
that looks like it's dead.
But do you see companies, you know, buying their real estate again? Anyone
I think
wanna-
large companies will be. I think smaller, medium-sized companies won't be, unless they're owner-occupied.
Yeah, I think Google's acquisition was very strategic there, you know, to be close to the fiber connections. But I do see the larger entities. I do agree with Dave, are going to be acquiring their buildings. I think the condo market for office is going to heat up as well. I think.
Yeah, I think I was going to bring that up because
B of A just built a huge
right, but
you know,
that's the
tower.
large. But what about the small condo? There's an accounting firm. I used to be at 633 3rd Avenue was and half the building was converted after one of the recessions of '91, and the building is a office condominium. Now, nonprofits always like to go into an office condominium because they didn't have to pay real estate taxes on their property. There's one accounting firm who has a floor, you know, and Sal said to me, did I buy the floor at the right price? I said, when you bought it, yes, it was up to maybe $1,000 a foot. Now it's worth $800, but you're not moving anyway. Do you see, and do your clients come to you? Because there's a friend of mine who runs a credit union, and he bought his own space. Do you see more people buying office condominiums? I'm not talking about the Bank of America. That's really, that's a huge portion of a condominium.
There was a lot of talk of that when this lease accounting was getting kicked around, that would trigger a whole huge industry of companies condoing the space and buying them just because of the way it was going to be treated on the balance sheet. We haven't seen that. We haven't seen it more for financing reasons. If they want to, you know, like for example, 666 5th Avenue, they condoed the office and the retail, and they sold off the retail because they wanted to, you know, relieve some debt. So it's more for financing purposes than, you know, single companies buying condo space that I've seen.
Yeah, I don't see a lot of activity. People talk about it once in a while, but then they just lose interest and would just rather rent.
Jeff?
Well, we have a couple of clients that have condoed office space, so there is a small market for it. But it's more than that. You know, you look at an outlandish price paid for an office building. Until you break it down and you separate out the retail versus the office. When you can sell the retail, your price per square foot on your office comes down dramatically. And when you have
I think that's a great comment, because if you look, and I mean, Seth is 100% on 666. They sold the retail, but the best part was, you know, that was to help them on financing. But with the sale of the NBA store a couple weeks ago for $322 million, or $8,450, the highest price ever for a retail condominium. I mean, the whole building sold for $1.8 million, which everybody felt was crazy. But now when you see this piece, just one piece of the property being sold for $8,400 a foot, there's no way that Zara is ever going to get anything out, because it wasn't even that. There was another $76 million that they had to pay to get rid of the NBA and to do the improvements. So I think...
No, that's a part of the market that's been hidden. One of our clients who started this numerous years ago, he was the one that pointed it out to me. He paid $700 a square foot. How much retail is there? Value the retail, and now you're down to $300 a square foot for the office space. The office space then makes sense.
Yeah. I see that as well. We see a lot of the retail, the zoning now on some of the properties that our clients have are considering developing or considering selling the land. The attraction is if it's both zoned for retail and residential. It seems to be bearing a higher price and a higher interest. But going back to the office condo market, I don't see the demand at this point. You know, I think it makes sense for some larger for financial companies to own their own space, but I don't think there's enough demand.
An interesting concept, since many of us, especially Ms. Levine and myself, are older. I once had a show a couple of years ago, a number of shows, and I had Norman Sterner on it, and I brought up the terminology recourse, or for my viewers who don't understand the term, a personal guarantee on the loan or on their obligation. Have you seen that? Or as Norman said, I forgot that word. That word left my dictionary. I don't know about it. It's a word that I don't want to know. You see?
A lot of banks won't lend without it. Even if you've met, you know, excess equity requirements and such, given what they've gone through, they want the PGs, the personal guarantees.
It goes back to your question a few moments ago, your observation about younger generation and older generation, and where this younger generation, you know, they want to get into the market. One of the keys is for the gray-haired guys, sorry, at least for the two of us, for the relationship we
I'll give him some time.
for the relationship that we maintain with the patriarch of the family. It's important for us to work with that next generation and counsel them. Yeah, the deal can't possibly go bad. What's the difference? And then you start telling them history. And history proves deals can go bad. And your balance sheet is not going to cover that personal guarantee. You want to walk into the next office and tell Pop he's signing on $30 million? I don't have the nerve. So let's reconsider that.
You know, I think a great story is when I had the legendary Bill Mack on my show. And Bill tells the story of his father, who Bill really built the company himself, but the Mack company was there. And he said, my father said, Bill, you can take over, and you can also take over any personal obligations or personal debt. Bill said, I'm 30 years of age, Pop. He says, you want to take over the business? This is what comes with the business over there. Where do you see, you know, the growth? How do you make the decision? We were trying to bring this up. I brought this up on shows with regard to banks. How do you make the decision who's going to be the next, you know, Resnick family or the next Fisher family? You know, young guys come to you, to all of your firms, and they say, you know, I'm going to go out there, I'm going to raise money on the equity, you know. And you've seen so many generations, and you've seen generations of some of these people who really do well, and then some of them, you know, I don't want to tell. Watch some of my previous building New Yorks. I have some people who are riding high and falling low now. How do you make?
It's almost like an emerging stock issue. You know, you look at everything about it, you take a risk. Sometimes you work with them, fees are a little lower early on, and they become successful, and you have a great long-term relationship and a great client. Other deals or other clients, it just doesn't work out.
I think the banks, I think they look at that, but I don't think they're loaning on the fundamentals. They're not gambling whether this particular guy or that particular guy is going to be the next, Resnick. They're going to look at the fundamentals. They have too many restrictions on them now. Yeah, they look at the developers certainly, but I think they go back to the fundamentals. So I think it's more of the mezz loans, the exotic financing will look more and gamble more on the developer themselves.
One question which really doesn't relate to real estate, it relates to the state of accounting. When I was in the accounting business, as I said prior to the show, there were the big eight. Then the big eight went down to the big six. Then the big six went to the big four. So where do you see in the in the 21st century accounting firms? The once there was a place for the small, creative small firm. Do we see a resurgence that there'll be another new Big Ten, or what do you see, Ronnie?
Yes, that's that's our line. I think that we see it as that there's going to be an opportunity for a Big Ten, and because there's a substantial, as corporate America is growing, there's increasingly larger companies, and the opportunity for dealing with larger international and national firms is there. I think that there's always going to be an opportunity for the smaller firm. I guess.
But your comment, and I think the comment of the other guys, is the smaller firm of 10 people is not going to be that easy because there's so many complications and requirements, taxes,
between tax and SEC regulations and being
Right.
You have to be in a what's called a PCAOB registered with the SEC to deal with it. There's fewer companies that could.
I think you will find small firms will have a place, and if their clients are successful, I think they will lose them, because as they grow and grow and grow, and if they go to the public market, that 10-person firm just can't handle it, and the investment banks won't accept them anyway. On the tax end, if you want to be a tax-oriented firm, because many of the small companies and the family-owned businesses, they have one concern and one concern only. I don't want to pay taxes. Okay, I'll pay a little bit.
And with that comment, we have to say goodbye because nobody wants to pay taxes. But I'd like to thank Ronnie Conigliaro, Seth Millard, David McKelvey, and Jeff Levine. See you next week.
Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, GREENBERG TRAURIG, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Stephen Napolitano, First American Title Insurance Company, Friedman, LLP, Accountants and Advisors, GEMINI Real Estate Advisors, LLC, Genova, Burns and Giantomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Sterling & Sterling, Urban American, The Wickoff Group.